So we're slowly going to introduce some basic concepts that I use to be consistently 85% accurate over the past 10 years in trading. Okay. Maybe longer, but I just say 10 years, probably 15 or 20. So I'm going to go and shut off some of these confusing ones here so we can be very basic and just start with introducing a very simple concept that anyone can do right off the bat. Okay. So I'm going to open up. This is a commodity, by the way. So this is like I said, charts are the same for everything. We're going to look at stock charts, Forex charts. Technical analysis is technical analysis, and it gives you a hint of when to finally pull the trigger. Remember, we look at the economy, we look at the fundamentals, we look at the economic data, we look at the sentiment of the market. Technical analysis is not something you want to ignore, even if you know people that say they don't use it. This is a waste. You can actually use it to your advantage to pinpoint opportunities. This chart is kind of hard to read because we had such a big dip recently in the price. Let's go to the 4-hour chart. Okay, so what we have is basically the price of oil, okay? And what we have, you can see here, I'm going to overlay on the price of oil. I'm going to turn on the price of gold. Okay, so what does that do? Okay, we're simply comparing three different things. Okay, so this is what I'm going to do. I made the color gold. Okay, and what I'm also going to do is I'm going to go up here and click on compare. By the way, I have more than 3 indicators because I have the pro version of TradingView, so I can add more symbols. And I'm going to go, you can compare the NASDAQ. You can see how the market did in comparison, right? I'm not going to do that. I'm just going to type in a symbol, and I'm going to type in, we have oil, gold. Let's put silver. Okay. So I'm going to put silver futures, SI1. So it's the front month contract of silver. Okay. And I'm actually going to change it to say, let's change the color. Okay, I'm going to make it actually silver. And I'm going to make it thicker so you can see it. Okay, so what does this do? You can actually see on any time frame, the price of silver and gold typically move the same. And what I'm showing you is not just to trade silver and gold, but to trade anything. You can pull up similar products and get a hint of what might happen next. And this is a good example. So I have a monthly candle chart. So each candle here represents 1 month. So this is a very long-term chart. When you're looking at charts, you're always looking at the symbol at the very top. So you got light crude oil futures. And what that means is every single candle that's green or red is actually a candle of the product that is mentioned up here, which is light crude oil. Light sweet crude oil, West Texas Intermediate. Okay. And what I want to mention is we actually have, a good hint at what will happen next, simply because we actually can see that one of them will do better than the other. You can see at one point gold was higher, and then at one point silver was higher, and then again gold was higher. So they revert back to each other. When you know which two products will come back to each other, you can use that as a good hint. Okay. Okay, so here, what would you do if silver was higher? You would say, I'm going to sell silver and I'm going to buy gold. Now, you can see when gold was higher all this time period, then silver was higher. That's not a good time to buy silver. It looks overpriced compared to the price of gold. Okay. And by the way, guys, this does not mean the price of silver was more expensive than the price of gold. I've got two different axes here. On the left of the chart is silver, and on the right is the price of oil, and on the right of the right is the price of gold. Okay. So it's just what I've done is, rather than having one of them, which is only $18 versus the other one, which is $1,800, the chart would be too far away to see any impact I've overlaid the movements. Okay. So I'm looking at the percentage of the move rather than the actual price. And this will give me a hint at what point, as a commodity trader, I would want to buy or sell gold or buy or sell silver just by looking at the relation of one to the other. So what I'm introducing right now is simple technical analysis, even before we look at indicators. It's just comparing two different items to each other that are supposed to move in tandem. They don't always, because we don't want markets to be perfect, because then there will not be opportunities. So what we can see here, silver went back down more than gold went down. So I want to ask you, okay, I want you to type this in the comments, whether you're watching on a live stream or on this presentation on Zoom. I want you to type in the comment right now, what do you think, you're teaching me now, what do you think gold will do next? And what do you think silver will do next? Just based on this two lines right now. When gold was higher and silver was lower, then they swapped positions. Silver went higher and gold went lower. Then gold went higher and silver went lower, and they stayed like that for a while. And now what do we have? We have silver way, way, way down here, and gold even higher way up here. So there's the biggest, widest gap between gold and silver. They did not both move together. You tell me, would you think it's more logical to say, and it doesn't matter if you're a hedge fund manager with $1 billion or you have $1 to trade in your demo account? Do you think gold will have to come back down or silver to go back up or both for those two lines to get back closer together, considering the fact that they've never been this far wide when we look back decades from one another? They're detached. So this just is give you an idea, gives me an example that gold, if I was going to be like, hey, I want to go buy some gold, what do you think? I will quickly pull up a silver chart and say, guess what? I'm looking at the price of silver and the recent run up in gold. We did not have a recent run up in silver, which would have meant that they're just kind of like a justified pairing. Both went higher, but in case silver went sideways and only gold went up, it's not the best timing to be buying gold based off of that alone. Okay. Now, I'm not talking about fundamentals. I'm not talking about the fact that price of gold, some will argue, including myself, that it should be at around 10,000 US by now. I'm just saying, in relation of looking at two things logically, it does not make sense that one went up more than the other. They got a chance to come back towards each other. So either silver has to go way up or gold has to go way down, or both. They can meet halfway or 40% of the way or 10% of the way. So out of those two, if I told you you have to buy one of them, which one would you buy it? Type it in the chat. Would you buy silver or would you buy gold right now if I'm telling you that they need to come back towards each other? Okay. Which one do you think would be a better opportunity? Okay. So yes, I see people typing in silver. I prefer it myself personally. Okay. And I'm not even talking about buying physical or stocks or anything like that right now, the different ways of buying silver. I'm just talking about the direction of the price. So right now, we talked about the fact that, if someone said they think gold will go down, they were just as accurate. Okay. So they could just, based on looking at the technicals of the two prices compared to each other as a ratio, they could say easily that gold will go down or silver will go up or both. They are equally good opportunities. But remember how earlier we also look at three different types of things that are not even similar like gold and silver. It's the overall direction of the economy. Then we look at the stock or commodity. And then we look at the technical analysis, which is the indicators below, which we haven't even talked about yet. So the economy as a whole would make me believe, with unlimited Federal Reserve printing, I do not want to be on the opposite side of gold. When you have so much money being pumped into the system, meaning the balance sheet of the Federal Reserve is about to balloon like never before, because they need to, just to keep the economy alive, if that's what they want. So then if all that money is being created, and they just announced that they're going to do unlimited money a month or two ago, then what we're going to see is we need more of those dollars to buy the same amount of gold. So the price of gold will go up. So then if I have to choose now between gold going down or silver going up, I would pick silver going up and gold going up. So factoring in that, plus the fact that silver is undervalued to gold right now, there's another thing we could do is called the gold to silver ratio. You can actually divide the now, rather than looking at the actual chart, seeing the big gap between the two is too big of a gap that the gap needs to shrink. Another thing you can do is actually look at the gold to silver ratio, which historically, if you look at how many ounces of gold there are in the ground and how many ounces of silver there are in the ground, it should be about 10 or 15 times the price of silver. Meaning, if gold goes completely sideways for a while, silver would have to go up to $150 just to be at a proper relation to the price of gold based on how much there is in the ground. So historically, you can look at the historical gold to silver ratio, and we have such a big gap right now that also favors silver. So long story short, we covered that. We said, look at 3 different things. And if you need to help decide which one of the 2 you would pick, because before we were looking, I only want to buy gold and I want to know if it'll go up or down, and I don't know. So what we did is we compared it to silver to get a hint. What you can do is you can compare it to a third thing to get a hint. And who can message in the chat an idea of what I would be comparing? The hint is, look at the chart we have open right now. What is the name of the chart? The candles are representing what? Light, sweet, crude oil futures. So there's a method to my madness. Why do we have the price of gold and the price of silver on top of a chart of oil? And just the same way, you could actually have a gold chart and turn the price of oil on as a black line representing black commodity of oil. And then you can see where the chart may go up. So the candles themselves, if they're the referee and they're going to be like, okay, that's the price of oil and that's going to be the decision maker of where both of them need to agree to meet up again, which one has more potential to go up or down? Will silver go up or will gold go down to meet back to where oil was or is? So if you look on the candles now, so let's just look at the yellow line for gold and ignore the silver one for now. And we're just looking at the yellow line for gold and the candles. You can see a huge spike here in oil prices and not so much of a big oil spike in the gold. So what ended up happening? Remember, they need to meet up again. Why? Because they're both traded against US dollars. Gold is measured in how many US dollars per ounce. Oil is traded in how many barrels per US dollars per barrel. So if they're both inversely moving to US dollar and moving inversely to US dollar, technically they should be moving very, very similarly together. So what happens is that's why I picked these particular assets as an example to show you why the charts will probably come back together again and again and again. Very often, commodities that are all measured in the same currency. So here, until they start being measured in different currencies. But here you can see the candles, our oil price went up, but gold did not. What happened? Oil decided to come all the way back down to meet gold. Then they both rose for a while. I'm talking about the candles and the golden line. And they stayed together like they're supposed to behave most of the time. But when they don't behave the same, that is an opportunity now for us to find that discrepancy until they converge back again together. So what ended up happening? The gold actually overtook oil and went higher than the candles. Then the candles went higher than gold. Then the candles went lower than gold. Then they touched again. And then the candles, which are oil, went lower. Then they touched again. And what do we have now? Oil prices crashed, okay, in the last year. This down move here is just because of the lockdown. But even if you delete any crash due to any lockdown at all, and we just use this level, you still see a big wide discrepancy where gold is way higher than oil. Okay, so what this is telling me is maybe the economy isn't so strong as they're making it sound on television. Because you don't need oil to create goods. You don't need oil to transport goods. By the way, Ed showed a great chart of showing the different trade slowdown around the world. Well, guess what? A part of that is attributed to supply disruptions, supply chains. Even if they want to create goods, it's not as easy to go back online creating materials and getting supplies to create goods. And this tells us that oil went down. There's maybe a less demand going forward, and people are usually using gold as a hedge against instability in the markets. So people are scared, they buy gold. Okay, so this is why we do believe we will hit an all-time high for gold, regardless of how much they've artificially manipulated and depressed gold and silver prices. That could be the play of the decade, actually. Silver right there. Just saying, on the record. Okay, so it's 2020 July, and we're saying that silver could be the best and most undervalued play possibly going forward for the next 10 years. Anyway, so that's just a way that you can compare three items to see that gold actually has a lot more room to go down just to meet where oil is at right now versus how much silver can jump up, which is more in line. However, we still think that silver is oversold here. That is just based on the technical analysis. This is just for education purposes only. Okay. Then what we can do is we can look at technical indicators. Okay. So for example, what I'm referring to is this. Let's say we have a chart, right? And what we're doing is taking this exact same picture we have up here right now, and we're just drawing indicators. So you can even do indicators on indicators. For example, I can draw a line like this. And what I'm doing this on is the MACD. It's a moving average convergence divergence. It's just one of the indicators that we will be covering and teaching you how to read. I'll go a little bit into it today. Basically, this is showing me that that's where the price of oil should be. Not tomorrow, not today, but yesterday, the price of oil should have been up there, around $90. Based on the very, very, very long-term historical past. I'm looking back decades upon decades. Okay, so what that means, I can draw a shorter term indicator here, just looking at the recent past. And even still, we're looking above 40, it's $40 right now. It could be 49 very easily. To go from where we are up, I'll make it a green line. We could potentially see a spike of oil up to $50. However, we would need Angola. See, now I'm switching from technical analysis to fundamental for a short moment. We need Angola to start cooperating with OPEC Plus, which is all the main oil producing countries led by Saudi Arabia talking with Russia as the plus and not official partner. But if Angola, which is part of OPEC, doesn't agree, it might be ignored. They're not the biggest producer, but they are big deals. So, Russia might say, I need all of them to be on the same page before we cut production. So then, that was one of the reasons people blamed the big meltdown earlier in the year. So, Russia did not agree to cut production